On the one hand, the consumer has no problem buying a $3,500 Vision Pro from Apple. On the other hand, the consumer can't afford a Big Mac with fries and a Diet Coke from McDonald's. On the one hand, the consumer is willing to shell out $34.99 for the vinyl version of the Tortured Poets Department by Taylor Swift. But the consumer is also struggling to pay $1.25, the core price tag of something bought at Dollar Tree. How's it possible? And how does it impact our markets on a day like today, where the Dow lost 274 points, S&P declined 0.32%, and NASDAQ dipped 0.20%, although I have to tell you, at one point mid-morning around 10:30, we were down so much more. The answer, frankly, is pretty stark. It's not one consumer. There are two consumers in this country. There's a consumer who's spending a fortune feeling extremely flush. Then there's a consumer who's extraordinarily pressed and can't afford to go out because prices have gone up too much. It's like we do have two countries here. That's how stark these divisions really are. As long as the wealthy consumer isn't struggling and the cash-strapped consumer remains under pressure, we know that inflation remains a problem. And if inflation is a problem, the Fed is not going to cut interest rates anytime soon, something confirmed by Fed Chief Jay Powell in his appearance on CBS 60 Minutes last night. So if the short rates that the Fed controls aren't going down, there's this difficult reverberation in the bond market that causes longer-term rates to go higher, making everything even more expensive for those who have little money, without really impacting the wealthy. In other words, it doesn't help to raise rates from here. But if the Fed cuts rates and inflation comes back, it's even worse for the consumer. The consumer's in a jam, at least one of the two consumers. It all comes down to statistics. Take last Friday. We got that hourly earnings from the Labor Department non-farm payroll report, and, well, the wages were up 4.5% year over year. Now, that was more than expected. Robust? Robust enough to rankle the bond market. The combination of higher wages with 353,000 new jobs added had investors furiously dumping bonds, something that sent them down in price and up in yield. That process continued today. Now consider the weaker earnings numbers that we got for today from McDonald's, the one that caused the steady, reliable company's stock to plummet $11 to 3.73%. Sure, some of that's about their business taking a hit from protests related to McDonald's because one of their franchisees in Israel offered a discount for Israeli soldiers, not popular in some parts of the world. But there's something else going on, too, something that's indicative of the two-consumer country that I'm talking about. The terrific CEO of McDonald's, Chris Kempczinski, talked multiple times on today's conference call about affordability. You usually don't hear that on McDonald's call, and how the consumer's trading down, even at McDonald's, in part because the company's put through mid to high single-digit price increases to cover their own inflation costs.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.